Section 4E is going to be about federal income tax. I don't believe it says it anywhere in this activity, but if you were to read the textbook on this section, it makes a claim at the beginning that federal tax is not really that complex of an idea, and we should be able to do these things. In fact, as a kid, I remember like my dad would do the taxes on his own, and they just basically had a little worksheet that you'd filled out. I think from that point, though, stuff has gotten a little bit more complicated, and I'm going to be honest with you. I use TurboTax. I like taking all the information, just putting it into the computer, adding all the, you get a whole bunch of forms. You can either download now or they get mailed to you, and you just get them into the system, and it tells you what forms you should be looking for, and all the stuff goes in there, and then it makes a lot of decisions for you. All right, so for the very beginning here, just up here, problems number 1 and 2, the idea of those is to just get your mind thinking a little bit about taxes, and they ask you a couple questions. The intentions that you're going to get the answers right are not really there. They just they tell you that there's a lady, she's single, and she has this income of $44,500, plus she's going to get some interest from a savings account, which is going to bring it up to $45,000. And you have this chart where you got a whole page of like charts. This is almost like a map that we can follow, and we'll talk about that in a little bit. There's a chart in the middle of this that talks about like what brackets you're going to end up in, and you get the different percentages here. So if you were to look up the $45,000, that one is, see, 10% goes up to $9,300, 15% goes up to $37,900, and then 25 goes up to here. So the $45,000 is greater than the 37, but it's going to be less than the 91. So she falls into the 25% tax bracket. Okay, now there's a lot more going on than just being in that bracket, but that's what they want you to be able to do, is to take out a couple of the key words and numbers that you see in that, and look at this chart and say, well, it has something to do with what's going on over here. Now it ends up that the answers that you put in these spots are not really going to be correct. So I'm not really going to break down like why I chose those answers, except that what you saw, the 25% there. Okay. All right, so we have some definitions that we need to get through here, and these definitions are going to refer to things that are in this little chart here. All right, this little chart, let me talk about like the shape of it first, because I think that'll help out once we understand what's going on here. Each of the boxes are going to represent some amount of money that we've got. So there's a gross income. We'll talk about what it is in a minute. You've got a gross income, you've got adjustments to income, and you've got adjusted gross income, and I could read all these if I needed. But there's these little bars in the middle here, and these are like those equal signs. Back when you were a kid, when you would add problems and you'd stack numbers and then you put a long bar underneath it and then the answer is underneath that, that's what this is here. Okay, so you're taking a gross income and you are subtracting, it says minus here, but you're subtracting something from it, and it equals a new value. You then take that new value, it becomes the top of another little equation here. Then you subtract something from that. You can subtract deductions and exemptions, and that equals some new number. All right, then this is a little bit trickier because it doesn't go straight into this number. But you'll look at a table and you collect a little bit more values. It becomes a new number, and then you subtract something else from that one. All right, then that value moves over here. We subtract some stuff and we get there. So the chart is really like this step by step. Take a number, subtract one step. Take the new number, subtract new step. And it's pretty much the whole thing except for this one little jump, which is a little bit more complex. And that part right there, just as a heads up, that part going from taxable income to tax computation is going to be on this table here. All right, so our definitions. Gross income, that is basically the money that you earn throughout a year. It's going to include wages, so working at your job, any tips, also working at a job, profits from a business, if you own a business, but you're not getting paid hourly because you just make money off of it. It's all that. It also includes interest or dividends from other investments and any other type of income you receive. So basically any money that's coming in we need to account for it, and that's the very beginning. Okay, but you don't get taxed off of all of that. Some of those things, some of that money is going to get reallocated, or some of it's not going to count against you, and that's where the next part's coming. So that's your gross income, which is your very beginning part. All right, the adjusted gross income, let me go back to that chart again. I'm trying not to flip back and forth too much. All right, we're going to go from gross income to adjusted gross income next. The adjusted gross income, also called the AGI. Some of your income is not taxed. Most likely what we're going to be looking at in our examples here are going to be any money that you put into IRAs, 401ks. It's going to be all of your like savings plans. So if you have like, I don't know, like $300 every month taken from your paychecks and it's put into a retirement plan, that doesn't get taxed. Okay, it doesn't get taxed. Later on, when you withdraw that money, there's some taxes involved at that time, but right now you're not going to be paying any taxes on that stuff here. So that money, like the whole amount of that money, will just get removed from your gross income and it becomes your adjusted. Let me see if I'm forgetting anything else that's in that category. I think that's all. Like this textbook is gonna hit on for that part. All right, so you got gross income, you subtract anything that you're putting into savings for retirement, and then it becomes your adjusted gross income. So on our table, that gets us to here, which is now going to be our next starting point. And then from here, we will be subtracting your deductions and exemptions, which then becomes your taxable income. So next term here is taxable income. And it should say here that we're taking out exemptions and we're also taking out deductions from this part here. All right, so on this chart, lots of stuff going on here. You have different ways that you can file. You can file single, you can file married, jointly, married separately, and then you got head of household. So you got a lot of different ways that you could be filing here, and you get your deductions. They're right there in this row. So if you're filing single, then you get to deduct that amount of money. If you're filed married jointly, then this number, you just double it, and that's what this is. So you're still getting that per person, right? So that number is the same thing. Head of household, not going to get into any of all that stuff there. But you can see that if you're filing married, it's just going to be that number double. So basically, it's like $6,350 per person that you get to deduct. So that'll come out. And then exemptions are going to be for if you have like dependents sort of thing on that. Okay. So like if you have a dependent, then you can take off another $4,050 as well with that one, and that also applies to you. That one also applies to you as well. So like if you have a child, you're single and you get your own child, you get to do 2 exemptions, which will multiply that by 2. All right, and then after that, let's see where we're at. You take out your exemptions, you take out your deductions. So we're just continuing to subtract money from this, and that'll get you to what would be your taxable income. And then like after this part, you're gonna really visit this table and you're gonna do like some fine tuning in your numbers. And then you got one last thing that you can subtract, which would be any types of tax credits. So those might be like childcare, charities that you donate money to, and maybe some other things that would be involved in that area there. I should go back and mention one other thing. Exemptions and deductions. There's a standard deduction that you can choose, but some people will do what's called an itemized deduction, which means they can look at like all their expenses, and if certain expenses that would apply to this add up to being more than what the standard deduction is, then they do an itemized one. But I want to say most people, that might actually be true. Like the average person, the standard deduction is the one that gets used. You don't have enough things to do an itemized deduction for. All right, question number 3 is going to revisit Lydia that we had up at the top. Remember that she had a gross income of $45,000 because there's the 44,500 and then the extra 500 from interest. They did add in one more piece of information, which is that she's going to contribute $4,000 to 401k. That information was just not provided at the beginning because I'm assuming that this is what the writer wanted to do, is that they didn't want to overwhelm you with too many numbers right off the bat. They just wanted you to be able to take a look at the table and then figure out a little bit about how that thing's arranged there. All right, so what we're going to be doing is finding in the end here the total income tax that we're going to be in there. Okay, so it begins, as in all of these, it's going to begin with the gross income, which we had already figured out previously. That's adding the 44,500 with $500, and you get $45,000. Okay, but then next what we got to do is figure out the AGI, the adjusted gross income, and for that we subtract the $4,000 that's going into the 401k, the retirement plan that she has. Okay, so that's the new information. So now we're going to take that away. Okay, and it drops you down to $41,000. Okay, and then from there, we need to, I'm referring back to my chart, sorry. I should probably show you I'm doing things. I'm trying not to flip back and forth too much. But here's your 45,000. We take away the 4,000, gets you to 41,000. Okay, so now we're at 41,000. Next stage is to take away the deductions and the exemptions that she has. All right, so it says up here we're going to take the standard deduction and also going to do one exemption for herself. Okay, so she's single, no kids here. All right, so the standard deduction is the $63,050. The exemption that she's going to get is the $4,050. Again, I'll go back to the chart one more time here. If you choose standard deduction, there's that amount there, and then she's got the one exemption for herself. So you're always going to be looking in this part here for two things: what will be the deduction and what will be the number of exemptions that she has here. Most often we say standardized, but you'll see a few questions that'll do some itemized, just so you can see a comparison how that might work. All right, when you subtract all of that, it's going to drop it down now to 30,600. So what used to be up here is now about 15,000 less once you've subtracted all that. Okay, so the next phase is to take this and to figure out what is the taxable income, and then the tax, or this is the taxable income, and then figure out the amount of taxes that you're actually going to be paying for here. After that point, there's also what's called tax credits, but we're not doing that, at least not in this part here. Okay, so this is the number that we need to be looking for. Okay, so we're going to go to the table here. Single, that means don't look at anything over here. Just keep your eyes there, and you know your percentages. We already dealt with the stuff that's down there. So we're only in this column. $30,600 is going to be less than that number. So you want to find the value that's going to be bigger than what we're actually filing for. So it's going to be underneath the 37,950. So 10% is all the way up to this number. 15% is up to that number. So that's where she's falling. She never makes it to the 25%. So if you remember at the very beginning of the activity, with the little information that's provided, we might actually feel like we should have been in the 25% bracket, but she never really made it once you take out the deductions, the exemptions, and the 401k that we didn't know about at the time. Okay, so she's going to be here. Now, the way that this works is you're not going to calculate 15% on all of that money because she's into that category. The first $9,325 is going to be a 10% tax. Then after that amount, any amount of money that goes beyond this amount into this category and up to 37,950, that's going to get 15%. Okay, and I'm going to try and describe something real briefly here. Like for a person that makes $9,400, okay, $75 over this amount. If that person had to pay 15% on all of that money, they would actually end up with less than the person $900 or $9,300 and was only paying 10%. Okay, so there can't be this dramatic change in like, all right, you made that $1 more, you're up to $9,326. So now you got to pay 15% on everything because of $1. Okay, well then you end up losing like a lot more money as if you didn't make that. So, or we actually have these broken up into little brackets that up to that point everybody's going to pay 10%, and then beyond there you can pay 15. Then beyond that one you're going to pay this amount there. Okay, so what that means is there's a lot of breakdown in this calculation. Okay, so in the 10% bracket, because we go over the 9,325, all 9,325 is going to get multiplied by 10%, which will give you back $932.50. Yeah, that's going to be part of her taxes. All right, next, she is within these two numbers here at the 30,600. So what we're going to do is take that amount, subtract the $9,325 that she already paid taxes on. That's going to give a difference of $21,275, and that is what she's going to pay 15% on. Okay, not 15% on the 30,600, just the difference from the last category or bracket. That turns out to be that number. Okay, and then if she happened to go into the next category, and the next category, and the next category, then you would just have to keep adding all those different amounts in there. We just have two in this case because we're already to her final amount. So if you add these two values together, you're going to get 41,000. No, sorry, way too high. $4,123.75. All right, question 4. We've already talked about this. At the beginning activity, it looks like she should be in the 25% tax bracket. Okay, now if you knew more about that ahead of time, like you knew more about the calculator and you didn't pick that, then that's awesome. And I'm really happy that you did know that. But for most people, we're going to think real simple and go, well, I guess we're in the 25% tax bracket. But we figure out that she's actually in the 15 with all of your adjustments. That'd be the 401k, $4,000, the deductions that you're allowed to take out, standard deduction in her case, and then we also get to take out the exemptions. By the time you take out all those things, you can actually move into a different bracket. Okay, and even when you're in that bracket, we realize that we're not paying all of our money to that percentage there. Okay, so then question 5 says, because we're not going to spend or not going to be taxed all of our money in the highest bracket that we fall, how much of our money is actually being taxed at 15%? And it was the 21,275, which I'll just show you where that number is coming from. That was the difference between the 30,600 and the 9,325 that you already paid 10% on. So it was that number. Okay, that's what they're looking for there. 6, just a different question to kind of look at, and we do a whole lot of stuff involving percents in this class, so here's another opportunity of that. We look at the effective tax rate. So we've done things with the word effective before, or I might be mixing up some classes, but it's a lot like the APY. It's the way that we sense the actual change at the end of everything that's done here. So for this, all we really do is we take the amount that was taxed, right? So that was the end of that table, the 4,123. You take that and you divide it by the gross income, right? What did we end up with at the very end is taxing? What did we actually start with? Don't worry about any deductions and all that stuff, just from our gross. And it feels like you lose 9% of your money. So even though she fell into the 15% tax bracket, and 15% was taken from some of her money and 10% from other amounts there, with everything else that was removed at the beginning, it only felt like 9.16%. Still doesn't really feel good to think about a tenth of your money going away, but it isn't as high as it might seem from the brackets. All right, then 7, the part that we always like doing taxes for anyway, is your refund. When you have your paychecks and stuff all set up, you've usually got it designed that a certain amount of money is being pulled from your account and then going to the IRS. And what we kind of hope the situation is that you've got more money being pulled from your accounts than what you're actually going to have to pay in taxes. Like in Lydia's case, her paychecks took out a total of $6,200. All right, just as it went on, that money was like over 12 months of paychecks. That was the amount they got removed. But she only owes $4,123.75. Okay, the government doesn't keep that difference as just a tip, like thanks, we appreciate it. What they do is they pay it back. You file your taxes. Some people file the taxes and find out that they owe money, that they never that they didn't pay enough into this, or some people just don't pay taxes at the beginning. They just make a lump payment at the end, which is a kind of weird thing. But most of us, I think, are used to this. We've already got money pulled out of our paychecks, and then we find out that they pulled too much, and you get a nice little check there at the end. And her guy, she gets $2,000. It's pretty good. All right, 8. All right, so 8, we don't do a lot with this one because I think there would be too many details that we would need to know to be able to figure out this calculation, but an itemized deduction. Okay, so you have a choice. You can either do itemized deduction or you can do a standard deduction. The itemized deduction looks at individual things that that would amount to what is deductible. Right, there's mortgage interest, there's an example there. There's charitable contributions, donations that you make, and probably some other things that go in there, but here's a couple just as an example. Okay, so the idea is if those add up to being more than what the standard deduction is, then you should itemize it. It's kind of a simple math thing here. If these things add up to be more than what a standard deduction is, then use that one. If it doesn't, then just take the standardized deduction and call it a win. Okay, so if you add these two together, you're going to get $4,500. But the standard deduction is $6,350. Again, one more time at the table. Lydia filing single, that's what it is. But basically, you think of it as that's how much you get per person that's filing taxes, unless you're doing head of household. Okay, so that number is being bigger. Makes more sense for her to do the standard deduction and not to do itemize. Basically, this is money in your pocket. Oh, no, it's not exactly that. It changes, whatever the difference is here, that's going to change how much they're taxing from you. So that difference, you're going to be getting back whatever percentage that they would have been taxing on you for that. All right, number 9. Okay, so this is the one that kind of stinks. You also have something called FICA. It's just a separate part of all this. So we did all of our other taxes here, but then there's this whole other separate part which is called FICA. Federal Insurance Contributions Act, often referred to as payroll tax, is a tax on all income from wages, no deductions or exemptions, but not on income from investments. Okay, like if you have stocks and stuff, that's the one that's kind of like, you're not going to pay FICA on it. But if you're talking about a regular job or a business that you own and money's coming in that way, you're going to have to pay what's called FICA. FICA is usually deducted from workers' paychecks before they receive them and is used to pay Social Security and Medicare. So this isn't one that goes into your calculation at the end when you're doing taxes. That money is already like sort of removed from it. Okay, and then we do the taxes like separately. So you don't really worry about doing that one, but you probably see it on your paychecks. Those little boxes where they're missing. Okay, so for that, remember the only thing that doesn't pay or doesn't get charged the FICA, however you want to say it, is going to be like the investments that you have. Okay, so going back to this. All right, looking at the second page we have here, there's information on FICA that we could read about, but the main thing here is, well, we should read the top part. It's on wages, tips, self-employment, income. You don't get to make adjustments, exemptions, deductions, all that stuff to it. It's just kind of like you take the actual number from it, but it does not apply to income from sources as interest, dividends, profits, sales of stock. So money that you make from a bank account, stocks, any of those things are not going to apply to this. All right, this just has a couple like a couple categories that you go through, so not too complex in this part of it though. It's going to be 7.65% for the first $127,200 of income. And don't really worry about that. And 1.45%, so a higher amount of that. Oh, no, sorry, a lower amount. Got all mixed up there. All right, so up to that amount, and then once you get beyond $127,200, it's going to be 1.45% on all the money that's beyond that amount there. So a lesser amount on the top end there. Okay, and at this point, you're probably feeling a little bit overwhelmed with how much information we're giving you, but we're getting there. We are getting there. All right, so, this question here, we're going to be, obviously for Lydia, she's underneath the $127,000 mark. So we're only doing the one part of the thing. We're only doing the 7.65%, which of course change here is a decimal. Okay, but here's the catch. Pay close attention to this. We're not multiplying it by the $45,000. It's only going to be the $44,500 because that other 500, we're going to go all the way back to the beginning of the activity. The 500 was interest from a savings account. So that stuff is not part of FICA. It's only going to be the wages portion of it there. Anyway, calculates, gives you that number there. All right, questions 10 and 11. These are the two questions I kind of dread going through because they're really tricky to understand, like how the numbers work. The calculations themselves are really short. Like in 10, here's one of the calculations. It's 0.85 times 12,000, done. All right, and then B, that's the whole problem. That's there. But it's the idea of what's happening here that's very difficult, and that's the part that I want to do my best to explain. Okay, so I'm going to try. Let's hope I get this right. Okay, first off, I got two people whose names I don't even really know how to read. I think this one might be Imani. I had a student once that was named Amani that had an A at the beginning, so I'm going to assume that this is Imani, and then Faye. Don't really know either. I apologize for that, I just don't. Okay, Imani is going to be in a 15% tax bracket, and then Faye is going to be in a 35% tax bracket. Okay, each will itemize their deductions. Okay, so no standard deduction, and they both have a $12,000 mortgage interest during the year. They both pay $12,000 in mortgage interest during the year. All right, what we want to do is compare their true costs to the mortgage interest. Okay, so that's any money that you pay. You're not saving that money. You're going to write it off as a deduction because you spent money on it. Okay, but it is money that is being paid out. But because they are in different tax brackets, the way that it's, and they get to write this off in their taxes, the amount that they actually pay and goes away is, it feels different for the two different people here. All right, so we're going to talk about Imani first. All right, so she has she's $12,000 is going to get. Okay, let me think this through here. The way that I want to approach this first is to think, and this is not a true way to say it, but just kind of think this for a moment. If she's in the 15% tax bracket, then imagine it as though 15% of all her money gets taken away. 15% of all her money gets taken away. But for everything that we can write off as a deduction or an exemption, etc., any of those things, she does not lose the 15% on those things. Okay, so the $12,000 at the beginning, it's going to get removed before taxes are calculated. Okay, so that 15% is not going to get taken away from $12,000. Okay, the 15% is not going to be taxed from it. So that's almost like 15% of that money goes back to her. Okay, it feels like she saved 15% on all of that because she's not paying taxes on it. But it does feel like she's paying 85% of it. So if she's going to save 15% because it never went through the taxes, gets to keep that money, 85% of it is what she's actually paying. Right? It's something that she's paying $12,000, but because she's not paying 15% taxes on it, to her in the end, it's going to feel like she's really only paying 85% of that. So you multiply 85% by 12,000 and you're going to get this amount of money here. That's probably about the best I'm going to be able to describe that. So I hope that worked out somewhat fine. All right, 11 might be a little bit easier to see what's happening here. It's actually pretty close to what's going on in number 10 with if you don't pay taxes on something, you can sort of think of it as saving that money that you would have been paying taxes on, okay? But I think this one will make a little bit more sense. I hope it does here. All right, so we have a person who's single, has a taxable income of $27,500. The person makes monthly contributions of $150 to a tax-deferred savings plan. Their monthly take-home payment is reduced by blank amount. Okay, first, we got to figure this part out here. The $27,500 is going to put this person into the 15% tax bracket, okay? And I think that's a safe assumption that they're going to stay within that tax bracket because 27,000 is still fairly far above that one on there, and we don't need to worry about moving into the 10% bracket. Okay, so the way this person should feel is that 15% of their money is taken away by the government. Again, that's not totally true, but the top part of their money, 15% is being taken away, and that's where this this tax deferred $150 would kind of sit. It sits at the top of the money, so it's part of the 15% portion. So it's all right kind of to say we expect 15% to get taxed. All right, so there's a paycheck that a person's getting, and they're normally getting whatever X amount of money on there, and they feel like they're paying like 15% for some of the money that's in there, including from that 150 that's in there. So, what do I want to show in this part here? Okay, if that money is pulled out and put into the savings plan before any taxes are done, you're not paying 15% on that amount of money. Okay, so if that money was just still like in your paycheck and going to go to you, you'd have to pay taxes on it before you actually get it, which means you're going to lose 15% of the $150, $22.50, right? The money that, so we're trying to designate, there's this $150 that we're following that's sitting in your paycheck, and right before taxes are taken, it's $150, but then taxes happen and $22.50 gets removed from it, it's gone. So you're really only getting $127.50 of that money. But if you decided to put that 150 into a savings plan, then the 2250 is never removed from it. It just stays with it and it all transfers over. So the way that we see a difference in your paycheck is not, we don't look at our paycheck and say, well, if I take out 150 and put it into savings, then my paycheck is going to be $150 less. Not really, because you were going to lose the $22.50 to taxes anyway. The way your paycheck is actually going to feel less is going to be $127.50. All right, question number 12. Last question, but it is the entire fourth page. We're going to be completing this whole chart here. What we have are two people that have slightly different situations, and we're going to just calculate their taxes. We're going to go through all the different parts that we saw today and see what they owe at the end. All right, both of our people, we have Ajax and we have Destiny. Their names are mentioned somewhere in here, but they both have an income of $95,000. All right, so they're both going to be starting off with a gross income of $95,000. But the difference is where that money comes from. Okay, so Ajax is going to get his money entirely from investments. It's going to be long-term capital gains since he benefited from the death of a distant relative who left their entire estate to him. That part, we really haven't done much like examples with that portion of it. So there's going to be another piece from that chart that we're going to have to take a look at, and I'll explain that one when we get there. Okay. All right. The other one, which is going to be much easier, is Destiny. This is going to be your more typical person that her money comes from income, it's wages. Let's see. She's going to give money to her IRA, so that's the tax deferred stuff, that part of your creating your AGI. Let's see what stuff. We're going to be calculating the FICA. We're going to be calculating the federal income tax. They're both going to be single. They're both going to claim a standard deduction. That's good. Don't got to worry about itemized. They're going to do 2 exemptions because of themselves, and they each have a dependent. Looks like that dependent is going to be a child because they're also going to do a child credit for that dependent. And the child credit is going to be $1,000 here. Okay, so that's the tax credit. We didn't do any problems with that either, but that happens after we do this table. After we're done with that table, you then get to do your child care tax credit at that part. All right, so as far as the table, I keep, wondering here whether or not I should like do one person and then the other one, or do them simultaneously. So I'm going to try and do them simultaneously, but it might get a little bit confusing because they each have different situations in certain parts of theirs, but maybe the compare and contrast is also good. Okay, we're going to start with FICA, which we just calculate and then we leave it alone until we get towards the very end with this thing. So FICA is just about the $127,000 thing here. All right, the $127,200. The government is going to be taking 7.65% up to that amount, and then the 1.45 beyond that amount, unless that money is made off of interest or capital gains. And that's what Ajax has got his money from. So Ajax is not paying any FICA tax at all. His is a 0. Destiny, on the other hand, we need to take the gross income. So this is, remember, FICA is, I wanted to write it, that's a lot to write though. It is before deductions, exemptions, etc. It starts with that gross income and you have to take the percentage of that. Okay, so we're going to take that percent, we're going to end up with $77,267.50. All right, so that's FICA. Nothing because capital gains, the 7%, 7.65%, because the money is that traditionally earned money. All right, next we're going to start looking at the income tax part. So we'll come back to the FICA later. We're not building on that part now. All right, gross income, they're both the same. They're both at $95,000. Okay, so then the next thing that we need to do is figure out the adjusted gross income, and we're going to be doing that by minusing certain things. Okay, so the adjusted gross income, Ajax is still going to be $95,000. That one doesn't change. Destiny's does change. It drops down to $90,000 because she's putting money into a savings plan. He's not doing any of that, so his just stays at that number. So you see hers. So this is going to be your more traditional going on over here, and really get that one down. But at the same time, we need you to know this one. It's maybe easier to understand it based on the differences between them. All right, so if we got our AGI, next what we're going to do is take away deductions and exemptions, and that'll get us to what is called taxable income. Okay, so here's our taxable incomes. These are the end results that we're going to get because we do these things. They're both going to take a standard deduction. They're also both going to take two exemptions, one for themselves and then one for what I'm assuming is a child here. Okay, so it's 2 times the 4,050. Once you take all that away, this is what their taxable income is. All right, and then after that, what we're going to do is we're going to calculate our tax based off of that bigger table that has all the up to amounts here. So referring to this one. We'll come back to him because that's the one that gets like real confusing. Okay, in a more traditional one here, let's see, where's our number? We got to take the $75,550, and that's just going to get broken into the brackets. Okay, so that amount, $75,000, is going to get into the 25% tax bracket because it is over 37 but less than 91. I noticed that it used to be 95,000, so it never got into like the 28 because it actually is dropped underneath that amount. All right, so we're going to do 10% for that first 9,325. We're then going to do 15% for all the money between the 37,950 and what we already paid there. So that's the entire amount of money that you could pay within the 15% tax bracket. And then we take her actual amount minus the top of the 15% bracket to figure out how much money is going to be within the 25%. So I didn't break these down individually, but all together, if you add these together, it turns out to be a grand total of $14,626.25. All right, this guy. Where are you at? Okay, so this didn't get mentioned anywhere else like in the packet, so now this is brand new. There's just so much stuff that's going on here. Okay, because he's a capital gains person, we need to adjust how that table is working, and it shows up. This is the FICA tax page here. If you go to the bottom part, dividends and capital gains, this is the portion that we need to look at here. It says here that there will be 0% for income that would have been anywhere in the 10% and the 15% bracket. So that's all the way up to that $37,950. Going to pay 0% for any of those two. Okay, and then all the brackets that are above that amount is going to be 15%. Where for everybody else it starts like at 25, it's going to start at 15% for these people. And that's going to be consistent all the way up until you get to that. I think this is the highest. Yeah, the highest bracket is 39.6%. That bracket, whatever that amount of money is where it transitions, is going to be at $20,000 or 20%. Okay, so capital gains up to that amount right there is 0%. All right, and then all the way up to $418,400 is going to be 15%. So I'll go ahead and write it here because I don't think I need this later. All that is going to be 0%. This is going to be 15%. And that is going to be 20% for your capital gains people there. So that's this guy. All right, now all right, after our standard deduction and our exemptions is going to be at the 80,000 mark. So, that's going to be above that number. So we're into this category, which is the 15% here, but it's going to be 0% on the first $37,950. So 0% on that amount, but then 15% on the difference between the taxable income and the top of that bracket, the 37.9. So you're really just subtracting these two numbers, multiply by 15%, and you get 6,390. All right, what's next? Tax credits. Yep. Yeah. All right, so it says it here as the actual tax bill. Oh, after child credit. Yeah. So any tax credits now that you have this last portion of it, Each of these had the $1,000 that is going to be for the child care. I think I mentioned that briefly at the end of number 12's prompt that we're letting it be $1,000. Also happens to say it. Not super convenient, but it says it up there. That's where that number is coming from. All right, so you just take away $1,000. Done. Got that part. All right, the next, I might not be able to predict what is coming up next, so I'll just slide it down for each time. Effective tax income. Pretty much the main calculations are done here. We've done all the detailed kind of work, and maybe the rest of these are just the easier problems. You're going to take what was actually paid in taxes, or is owed, what's the bill, and divide that by the gross income. So they're both going to get divided by $95,000, and you end up with these percentages. So again, this is like the percent that it feels like you paid in taxes when all things are said and done. All right, so let's see. Next, the overall tax burden. This is kind of weird because remember, FICA gets taken out. If you do have FICA, it gets taken out at the beginning, so you don't really seem to notice like that one so much. It's on your little pay stubs and stuff like that, but you don't really seem to notice that one. More it's like the other taxes and stuff that we tend to pay attention to. Okay, remember that Ajax had no FICA. All right, so his tax burden is still just going to be the $5,390. Destiny did have the FICA, which was that $7,000 amount that was up at the very top. So if you add that onto the $13,000 amount that we have here, is a total of $20,893.75. All right, and then we'll do a percentage now with these. So like what we did just above, we're going to take that number and that number, and we're going to divide them by gross income. Nothing changes for Ajax. It's still the same thing, but this number is going up. So now it appears to be 22%. And your money is just floating away, floating away. All right, and then at the end, question number 13. So we're doing something different now. It's a new problem. Taxes have been calculated. And we did some of these problems way back at the beginning of the semester. So hopefully remember these. All right, what we do if we want to complete this blank, it says comparing the total tax burdens percentages that Destiny paid is blank percent of the percentage of Ajax. What we want to do is take her percentage, which is about 22%. I think it was like 21.99, so it really just rounded up to here. You're going to take that percentage and you're going to divide it by Ajax percentage here. And when we divide those, we get this number, 3.8782. So what that means is that you would have to multiply his percentage by that number to get to hers. Okay, but then when you change it to a percentage, so this is a factor, when you change it to a percentage, you got to move the decimal over 2 spots. So it ends up being 387% of his. And that sounds a little bit crazy, but remember, like 100% is 1 of something. Okay, so if her percent was 100% of his, it would still be the 5.67. If it was 200%, it would be that number doubled. 300% would triple that. And I think now you can probably see why it would be 387% of that. Factor, percentage.